Listen, if you are over the age of 65 or you are helping your parents manage their retirement fund, you need to stop what you are doing and pay very close attention to every word I am about to say. We are standing in the first month of 2026, and the tax landscape in America just shifted in a way that most people are completely unprepared for. While the mainstream media is busy talking about the latest political scandals or the fluctuating stock market, something massive and quiet happened inside the tax code. I am talking about a multi-$1,000 gift from the Internal Revenue Service that 90% of seniors are going to miss entirely because they are still filing their taxes like it is 2024. I know exactly how you feel right now. I have seen the thousands of emails hitting my inbox. You have watched inflation eat your Social Security cost of living adjustments for breakfast over the last few years. You have seen your grocery bills stay stubbornly high while your required minimum distributions, those distributions you are forced to take from your retirement accounts, are threatening to push you into a higher tax bracket that you never asked for. You feel like the system is designed to drain your nest egg just as you are trying to enjoy it. You feel like the harder you work to save, the more the government wants to take back now that you are in your golden years. But what if I told you that for this 2026 filing season, there is a hidden door in the tax code? I am talking about a way to potentially shield an extra $6,000, $12,000, or even more of your hard-earned income from the government. This is not some strange internet scheme or a gray area tax dodge. This is written into the federal law known as the One Big Beautiful Bill Act, or what the experts are calling the OBEBA, which went into full effect this month. We have moved beyond the old 2025 rules. Last year, the standard deduction for a married couple filing jointly was $31,500. This year, for 2026, that has bumped up to $32,200. But that is just the basic, boring part that everyone knows. The real gold mine is a brand new line item on a form that most of you have not even looked at yet. I am talking about the IRS Schedule 1A. Most tax professionals are so overwhelmed with the new corporate tax changes that they have not even briefed their senior clients on what we call the enhanced senior deduction. This is a specific targeted $6,000 deduction that sits right on top of your standard deduction if you meet the income requirements. If you are a couple, we are talking about a potential $12,000 shield. But here is the catch that should keep you up at night. The government is not going to call you and tell you to claim it. If you do not check the right box on the new Form 1040 SR, that money stays in Washington. It does not go to your grandkids' college fund. It does not go to your travel budget. It just vanishes into the federal treasury. I want you to think about a couple named Bob and Sarah. Bob is 68 and Sarah is 66. They have worked hard their whole lives. They live in a modest home in Florida, and between their pensions, their Social Security, and a bit of part-time consulting Bob does on the side, they are bringing in about $162,000 a year. Last month, Bob sat at his kitchen table, looked at his old tax returns, and realized they were on track to owe the government nearly $4,500 by April. He was panicked. He thought they did everything right and wondered why they were being punished for having a little bit of success in retirement. Bob and Sarah are the reason I am speaking to you right now. By the time we finish this deep dive, I am going to show you exactly how this 2026 loophole is going to take that $4,500 tax bill for the Wilsons and potentially shrink it down to zero. We are going to do the math together. I am going to show you the exact formulas, the income phase-outs, and the charitable backdoor that no one is talking about. Before we go any further, I need you to do something for me. If you want to keep more of your money and you want the IRS to take less of it, hit that like button right now. It tells the algorithm that this high-level financial information is important for seniors across the country. And if you have not subscribed yet, click that button and turn on the notifications. We are in a brand new tax era in 2026, and I am going to be here every week making sure you have the tools to protect your wealth. If you have already subscribed, share this video right now with one friend who is over 65. You might literally save them $3,000 with one click. Let's get into the engine room of this strategy. We have to talk about Section 701(3) of the OBBBA. This is where the Enhanced Senior Deduction, or the ESD, lives. When you look at your 2026 Form 1040 SR, that is the big print version of the tax form designed specifically for seniors, you are going to see a small box on page 1 that mentions Schedule 1A. You cannot ignore that box. In 2025, the game was simple. You either took the standard deduction or you itemized your deductions. For the vast majority of you, the standard deduction was the clear winner. But in 2026, the government added what I call a layer cake strategy. The enhanced senior deduction is designed to help the squeezed middle class. If you make too much for certain state credits, but not enough to have a team of offshore accountants, this was written for you. The full deduction is $6,000 for individuals and $12,000 for married couples filing jointly. But there is a very specific phase out that you have to understand, or you will calculate your savings incorrectly. For married couples, the magic number is $150,000. This is what we call the cliff. Let's look at Bob and Sarah again. Their total adjusted gross income is $162,000. Since they are $12,000 over that $150,000 cliff, the IRS starts to take back the deduction. The formula is a 6% erosion. For every dollar you earn over the limit, you lose 6 cents of that $12,000 deduction. So for Bob and Sarah, we take that $12,000 of excess income and multiply it by 0.06. That gives us $720. That is the amount they lose. So instead of the full $12,000 deduction, they get to claim $11,280 on their Schedule 1A. Think about the impact of that. Just by knowing that Schedule 1A exists and doing that simple calculation, Bob and Sarah just wiped $11,280 off their taxable income. Since they are in the 22% tax bracket, that is $2,481 in actual cash staying in their pocket. This is why you cannot use last year's logic. If Bob and Sarah had just used a basic tax software and didn't look for the new 2026 forms, they would have missed that $2,400 saving entirely. Let's compare 2025 to 2026 side by side so you can see the scale of this change. In 2025, the standard deduction for a married couple was $31,500. They also got a small extra deduction for being over 65, which was about $3,100 combined. That gave them a total shield of $34,600. But in 2026, look at the difference. The new standard deduction is $32,200. Their senior add-on has increased to $4,100. And then we add that massive $11,280 enhanced senior deduction we just calculated. Their total income shield for 2026 is now $47,580. That is nearly $13,000 more in income that is completely shielded from federal taxes compared to just 1 year ago. If you are not jumping out of your chair right now, you aren't listening. That $13,000 difference represents thousands of dollars in actual taxes saved. Now let's talk about the charitable backdoor, which is another huge part of this 2026 loophole. I call this the non-itemizer loophole. Bob and Sarah usually give about $5,000 a year to their church and a local animal shelter. In the past, they got zero tax benefit for this. Why? Because $5,000 is much lower than the $32,000 standard deduction, so it didn't make sense for them to itemize. Their donations were essentially invisible to the IRS. But 2026 changed the rules for people who do not itemize. Under the new guidelines, there is an above-the-line charitable deduction. You can deduct up to $2,000 for married couples directly from your gross income before you even get to the standard deduction. Bob almost made a huge mistake here. He thought that because he was already taking the big $47,000 shield, he couldn't claim his $2,000 donation as well. But the 2026 rules say you can do both. And here is where it gets really smart. By claiming that $2,000 on Form 1040, line 12B, Bob lowers his adjusted gross income from $162,000 down to $160,000. Do you remember our phase-out calculation from earlier? By lowering his income by $2,000, he actually saved part of his enhanced senior deduction from being eroded. We have to recalculate. Now he is only $10,000 over the cliff instead of $12,000. 10,000 multiplied by 0.06 is $600. His new deduction is $11,400. By giving to charity, Bob didn't just feel good. He mathematically unlocked more of his senior tax credit. I want to pause here because this is exactly the kind of deep dive strategy that the big banks and the high-priced wealth managers keep for their million-dollar clients. But on this channel, we believe that every retiree deserves to know these secrets. If you appreciate me breaking down the math like this, please make sure you have liked the video and leave a comment below with the word saved. It helps me know that you are following along with the calculations. We also have to discuss a very serious ticking time bomb that these 2026 tax changes can help you avoid. It is called IRMAA, which stands for the Income-Related Monthly Adjustment Amount. This is the surcharge that the government adds to your Medicare Part B and Part D premiums if you make too much money. Medicare has a 2-year look-back period. That means the taxes you file this April for 2026 will determine how much you pay for health care in 2028. If Bob and Sarah's income stays too high, they could get hit with an extra $300 or $400 a month in Medicare premiums 2 years from now. That is a massive hidden tax. But by using these 2026 loopholes, the enhanced senior deduction, the above-the-line charitable gift, and the strategies I'm about to show you, they are keeping their reported income low. They are effectively shielding themselves from a future healthcare price hike. One of the most powerful tools Sarah can use is the Qualified Charitable Distribution, or the QCD. Sarah is 66. Even though she is not forced to take money out of her IRA yet, she can choose to move up to $115,000 directly from her IRA to a qualified charity. This is the ultimate 2026 power move. Why? Because that money never touches her tax return. It is invisible income. If she needs to give money to her church, she shouldn't write a check from her bank account. She should use a QCD. This keeps her adjusted gross income lower, which keeps her Medicare premiums lower and ensures she qualifies for the full $6,000 enhanced senior deduction. Now, let's get into your step-by-step action plan to get this done before the April deadline. You cannot wait until the second week of April to figure this out. The new IRS systems are already struggling with the OBBB integrations, and you need time to pivot if your numbers are not lining up. Step one is what I call the $150,000 check. I want you to look at your total income from all sources: pensions, Social Security, interest from your savings accounts, and any part-time work. If you are a married couple and you are anywhere between $150,000 and $250,000, you are in the phase-out danger zone. This is the sweet spot where every dollar you can legally hide will save you twice as much in taxes because it protects your senior deduction. Step two is to demand Schedule 1A. If you work with a tax preparer, do not just let them put your numbers into their software and tell you the result. You need to be proactive. Ask them specifically how they are calculating your Section 70103 deduction. If they don't know what you are talking about, that is a massive red flag. Many preparers are so focused on the changes to the child tax credit or corporate rates that they are overlooking this specific senior benefit. Step three is the time machine contribution. Even though we are in 2026, you still have until April 15th to make contributions to your 2025 IRA or your health savings account. This is a rare opportunity to use 2026 knowledge to fix a 2025 tax bill. If you are over 55, you can put an extra $1,000 into your HSA as a catch-up contribution. For Bob and Sarah, putting $8,000 into these accounts right now doesn't just give them a deduction for the contribution. It might push their income low enough to claim the maximum senior deduction. It is what I call a double stack of savings. Step four is to audit your donations. Go back through your bank statements for the last year. Every $50 you gave to a food bank or a veterans charity counts. Even if you are not itemizing, you must claim that $2,000 above-the-line deduction on line 12B of your 1040. Do not let the government keep your money just because you were too tired to look for a receipt. Step five is to run a dry run. Open your tax software or meet with your preparer this week. Do not wait. You need to see where your adjusted gross income lands. If you are just a few $100s over a cliff that would cost you part of your deduction, you still have time to make a contribution or adjust your strategy to save that money. I want to go back to Bob and Sarah one last time. When Bob first looked at his situation, he was prepared to write a check to the IRS for $4,500. He was frustrated, he was stressed, and he felt like he was failing his family. But after we walked through these exact 2026 loopholes, everything changed. By the time they applied the $300 increase in the standard deduction, the $11,000 enhanced senior deduction, the $2,000 charitable gift, and a small IRA contribution, they didn't owe $4,500. They actually ended up with a refund of over $1,000. That is a $5,500 swing in their net worth just from knowing the rules of the game. Bob told me that for the first time in a decade, he didn't feel like he was being squeezed out of his own retirement. That money allowed them to book a trip to see their grandchildren in Oregon that they thought they couldn't afford this year. That is what this is really about. It is not about spreadsheets and tax forms. It is about your freedom. It is about the fact that you worked for 40 years, you paid your taxes, you raised your families, and you contributed to this country. You deserve to spend your retirement feeling secure, not wondering if a tax bill is going to ruin your month. The 2026 tax season is going to be a total mess for people who are not paying attention. The forms are new, the rules are complex, and the stakes are higher than ever. But you are not in that group. You have the numbers, you have the form names like Schedule 1A and Form 1040-SR, and you have a clear plan of action. Before I let you go, I want to make sure you have all the tools you need. I have put together a 2026 tax cheat sheet that summarizes all these numbers, the phase-out formulas, and the checklist we just covered. It is completely free, and you can find the link in the description below this video. Print it out and take it to your tax appointment. It will make you the smartest person in the room. And if you found this information valuable, please do two things. First, subscribe to the channel if you haven't already. We are tracking every single update to the OBEBA and the Medicare Part B changes in real time. My team and I spend hundreds of hours reading the fine print of these laws so you don't have to. Second, share this video. There are millions of seniors across the country who are about to overpay their taxes by thousands of dollars simply because they don't know about the enhanced senior deduction. Let's help our community keep what they have earned. Comment below with the word saved if you are going to check your Schedule 1A this week. I try to get into the comments and answer as many questions as I can because I want to see you succeed. Remember, the IRS is not going to give you a discount out of the goodness of their heart. You have to go out there and claim what is yours. This is your money, your future, and your rules. I am so proud of you for taking the time to educate yourself and take control of your financial destiny. I will see you in the next video as we continue to navigate these 2026 changes together. Keep saving, keep planning, and keep your head up. Your best years are still ahead of you, and I am going to make sure you have the resources to enjoy every single one of them.